coming back to this point which I was explaining earlier, it says that it is 1,38 million dollars here, but while in the case of the problem, they said that it is 1,140 million dollars. So why is that there is a change in the cash from operating activities in all the 3 years? So here, if at all, you say that I have already mentioned that they have actually taken interest as part of the operating expenses, while we will be actually removing that. So that's the reason you will find that there will be a difference. So it was, how much was the outflow? What was the cash from operating activities here? 100,140, and then I add back that amount of interest which is actually adjusted in the investing activity, 37,883 million dollars. So that is why my profit would be, that is profit or cash from operating activities would be 138023. The same in the case of the second year and in the case of third year. What did I do with this interest is that I have taken this interest into the financing activities. That is what we need to do. So coming to one adjustment that I have done in the case of interest, you will see that rest of the other items remain the same. So cash collections, I have taken it here, this part, cash collections, that is collection from the customers I have written. So I can even write cash collections from customers, so that it becomes easy for you also. Yeah, cash collections from customers. Then if you are looking at the other operating activities that you are talking about the expenses and all, let us say for example here you have got the payment to the suppliers. This payment to the suppliers has been written here, payment for the merchandise, I would rather say suppliers, so that suppliers. Okay, and then you talk about your selling and general administrative expenses, the payments for the selling and the general administrative expenses 463. I have taken these items there, so that I am just converting it to gold so that it becomes easy for you. So these are the expenses that I have taken. In the case of tax paid, again I have taken the amounts that have been actually taken as a part of the working capital, as well as in the case of the deferred taxes, which is a non-cash item that they have shown in the income statement here. Say for example, deferred taxes 4090, that has been adjusted, 4090 that has been adjusted here, deferred tax. And the change in the income tax payable, you will find it in the working capital. Just an example, this is just an example. I think you'll have to look at every other thing. Tax payable 9003, that also has been adjusted. So similarly every item has been adjusted, and then we see that whenever we are looking at the cash from operations, you take all these items. One is your collection from the customer, the payment to the suppliers, the payment for the administrative expenses, and the tax paid. Now whatever has been taken, the other expenses that have been given over there, I consider it as operating expenses, and that is the pre-opening expenses and the reallocation expenses, which I consider it as operating expenses, and then it is considered to be paid in cash. These items have also been taken. So I find that in the case of 1992, after making the adjustment for the interest which has been transferred into the financing activity, I find that my cash from operating activity gets adjusted. It's the same thing what I have already calculated. So it is 1,38,000 million dollars, or otherwise 138 billion dollars. In the case of second year, my, that is in the year 1993, my cash from, that is cash from operating activities, are 132 billion dollars. While when I look at all these items, I sum up all these items here, I find that the amount is 129 billion dollars, and there's a difference of 2,434 million dollars, and that adjustment has been considered here as a balancing number. I get a balancing number in the case of second year and the third year. I remove this. Okay. In the case of second and the third year, I have found that there is a balancing number, and I said that these balancing numbers arises because of some amalgamations, acquisitions, divestitures, foreign subsidiaries, and so on. If at all you look at the and accounting adjustments, say for example, I'll just give you an example here. If at all in this year, if you are looking at adjustments here, you find that the amount of extraordinary loss is 5378 here, but while the extraordinary loss that has been adjusted here is 5430. And you will have to look into it why there should be a loss. So when you get into the notes and all, you get it. So these are the reasons why you would find that the differences arise in this form, and that's the reason I have taken it as any other income. So I will consider this as any other operating income. In this case, I would rather consider this as any other operating income. And now I have picked up the cash from investing activities directly from the problem that has been given. I have just summed it up here because as I said that operating, that is your investing activity and financing activity, it is directly as per the direct method. So this I have summed it up. Now there is no further information about the depreciation, amortization, and also I assume that it has been done thoroughly. It has been accounted thoroughly, and then they've given you the numbers over here. So I consider that it has happened, and that's the reason I have taken directly these numbers that have been provided to me in the text. Now, in the entire thing, if at all I see here, the interest paid I have considered, and rest of the items have been taken from the text. So, the cash from operating activities, cash from investing activities, and cash from financing activities. When I look at these three things, I get this cash net change in the cash. 1, 2, 3. And that is what it is, net change in the cash. 13379 as per the problem given. 3064, that is as per the problem given. 15379. These things are matching. So my cash flow has tallied. My cash flow has tallied, and let me see the analysis part. How do I analyze the entire thing? I will take the sales from the question that has been given to me, or rather from the working year. Sales 1, 2, 3. That is 2127 billion for 92, 93, and 94 respectively. It comes in, and I put it across here, sales. And the cash collections that we have calculated by taking in the cash collections here 1, 2, 3, and I take this here just for analysis part, because in the second bit he said that he has also asked us to calculate the percentage of cash collected against every element. So this is why I have to do this. So I find that my percentage of collections to the sales are almost 99%, 100%, and 99% in the year 92, 93, and 94. That definitely shows that my collection is very strong. There is no problem because of the collection. In fact, in the year 93, I have even made the collections better than what I have sold. Maybe I have got advances as well. In the case of the change in the sales has been rising the same way as what the change in the collections are. So I find that the sales have increased from, say, the percentage change is 13% here. Now it is in the 93-94, it is 13%. That is grown. It's not a great change, but then it's grown. Same in the case of sales, in the, the change of sales has grown at 14% for 92-93, and it has grown at 13.3. Well, I do find that the percentage change in the 92-94 has grown from anywhere from 29%. That's a great change. So I don't find any reason why there should be any worry for the credit manager to look at, because the collections to the sales show to be very strong, 99%, 100%, and 99%. Also the sales also are good. As I told you earlier, that you will have to calculate the growth in the sales, it's been done. You can always do it for COGS. I hope that you will do it for the COGS, though you can take this as a reference point. So the COGS also, there's a growth of cost of goods sold. It is 14% and 13% when compared to 92, 93 and 93, 94. While you look at the payments to the suppliers, the payment to the supplier is almost 98%, then it has gone to 99% when I calculate the payment made to the cost of goods sold. And in the case of the year 94, it's you are paying excess, you are paying 104%. Now this is something which is a cause of worry. When you are paying more, is something that you are not able to bargain with your suppliers about the payment part. So as a credit manager, you will see that you are making, one is your amount gets blocked, and the amount that gets blocked is to the extent of, if at all you see, to the amount gets blocked to the extent of 2 lakh rupees, and then you find that you have got an annual increase of 1 lakh 20,000, if at all you are looking at the COGS. Now when you will also look that, you can also see that here, when we see at the third part which he asked you to look at the earning before extraordinary items. The extraordinary items, the earning before extraordinary items have been increasing from 37,262 millions to 41 and 44,359 millions. This is something which one has to investigate. Why is that there is so much of earning in the extraordinary items, while the free cash flow has been reducing? It was $52,543 million earlier, and now it has been reducing. It is 326 in the year 93, and minus that is 33,292. A drastic sharp fall in the free cash flow. And you also find that the cash from operations are also reducing. Now this is a clear indication that the free cash flow is becoming negative, and it has fallen sharply from the year 92 to 94. And it also is an indication that you will have to improve on your cash from operations and depend for the instead of depending on the earning before extraordinary item, and your free cash flow has to improve. If at all you improve your cash from operating activity, automatically it will show up in your free cash flow. One. And so the second thing, what is the question that comes to my mind is, where did the cash come from to pay their debt and all? You see that in the 1993, in the financing activity, you can find that in 1993 it met its requirement by issuing stock, and in the 94 the firm short-term debt increased considerably as it credit lines also have grown. So it shows that the company has been depending more on the short-term loans, and it is actually also issuing the stock. No doubt, when issuing the stock says that there is the risk being taken by the owners, but when the short-term loans are being raised, then I will have my own doubts about actually extending the loan to this company, Radlock. I hope that you understand the outcome of this is to find out the differences of this particular thing. This is where actually is. So this would be the outcome of this session, to understand that there would be a balancing number, and this balancing number comes in the as a difference in the indirect method and the direct method due to the acquisitions divestitures. One. Second thing, this difference of operating activities has happened because of the change in the method that they have actually done, where as per the US GAAP they have taken interest in the operating activities while we do not take it. I hope that this will help you in solving the problem. Thank you for attending this session.